For a controller responsible for closing the books, inventory costing is not just about getting the final answer eventually. It is about knowing whether inventory, COGS, and freight-related variances are posted in a way that keeps the close stable and explainable. Carillon handles freight differences through the purchasing and three-way match process. When inventory is received, the inventory account is debited based on the received inventory cost. When the vendor invoice is processed, Carillon performs a three-way match and calculates cost, quantity, and freight variances. If freight was estimated on the purchase order or at receiving, the actual freight on the invoice is compared to that estimate, and the difference is posted to the freight variance account. If freight was not estimated, the full freight amount is posted to the freight variance account at invoice processing time. That means Carillon does not need to reopen the inventory receipt cost layer when the freight bill arrives later. The inventory costing subledger remains tied to the inventory control account, and the variance accounts capture the difference between what was capitalized into inventory and what was billed later. For period close, that distinction matters. Late freight does not require the controller to restate earlier inventory costs or revisit COGS on items that may already have been sold. NetSuite can include freight in inventory value through its landed cost feature. Oracle documents that landed costs, such as freight, duty, taxes, insurance, and handling, can be added to the asset value of inventory and contribute to COGS and profitability. That is legitimate and useful functionality. NetSuite's 2026.1 release also introduced automated landed cost validations and rule-based processing for greater control and compliance during PO receipt.
Both systems can account for freight. The difference is the control model. Carillon treats the freight difference as a variance during invoice processing, preserving the original inventory costing relationship and keeping the close easier to reconcile. NetSuite's landed cost model can capitalize freight into inventory, but for FIFO and average costing users, when freight cost is not known at receipt, the edit receipt workflow can trigger costing recalculations with downstream COGS impact. For controllers using FIFO or average costing, Carillon's approach is simpler, more predictable, and less dependent on landed cost timing discipline. The timing challenge remains for companies using FIFO or average costing. Freight costs are often not known at the time inventory is received. Oracle's own landed cost documentation says freight charges are commonly not known before the freight vendor's bill is received. If landed costs are not known at receipt, Oracle says an estimated amount can be entered. In another documented example, the freight bill arrives later, the user enters a freight vendor bill, then edits the original item receipt to identify the freight charge as landed cost. It is worth noting that NetSuite's standard costing method handles this differently. Landed cost creates a variance against the standard cost rather than modifying the cost layer. The timing issue discussed here applies specifically to FIFO and average costing users. That later receipt edit is the accounting control issue for FIFO and average costing. When landed cost is added later by editing the receipt, that later change can alter the item's costing history and trigger inventory costing recalculations. If related goods were sold after the receipt date, the recalculation can affect downstream COGS, which creates a dependency between the arrival of the freight bill and the finality of inventory costing. Oracle documents this directly. Inventory costing values need to be recalculated each time there is a change to the costing history of a particular item, and if the accounting period is closed while inventory costing calculations are still in progress, it can affect costing accuracy and cause errors. Both systems can account for freight. The difference is the control model. Carillon treats the freight difference as a variance during invoice processing, preserving the original inventory costing relationship and keeping the close easier to reconcile. NetSuite's landed cost model can capitalize freight into inventory, but for FIFO and average costing users when freight cost is not known at receipt, the edit receipt workflow can trigger costing recalculations with downstream COGS impact. For controllers using FIFO or average costing, Carillon's approach is simpler, more predictable, and less dependent on landed cost timing discipline.